Hello everyone, welcome to my YouTube channel ACCAWALA. Now today's topic we are going to cover is the second part of cost of capital. In this we are going to study what is cost of debt, what are the types of the cost of debt and how we calculate the cost of debt. So let's begin. In the second part on the cost of capital, in first part we covered the cost of equity and what is the cost of capital, how to calculate cost of equity. In this video we are going to cover what is the cost of debt. Let's begin. Before we are going into details of what is cost of debt, first we do one small thing is one small thing. In this we are going to learn estimating the cost of preference share, part of the cost of equity. Cost of equity, you remember, the thing you require to calculate the cost of capital is with the first one was cost of equity, second one was the cost of the preference share, and the third one is the cost of the debt. So in we are going to learn what is the preference share and how we calculate the preference share. Preference shares are usually have a constant dividend. It means that the preference shares have a constant dividend. The investors will receive a constant dividend. There will be a no growth. So in this we can use the same approach which we are using to calculate cost of equity when there was no growth. If you are not aware of what is cost of equity and how to calculate cost of equity when there is no growth in dividend, you please go back to the first part of this video. It is available on my YouTube channel. I also provide a link on this video. So let's begin. The formula for calculating the cost of preference shares will be KP equal to D divided by PO, whereas a D will be the constant. D means that the constant annual preference share. P0 equal to market value of the share. KP equal to cost of the preference shares. You have to learn this formula. Now we are going to do one small question on this. This is very simple and easy. So question was that a company has 50,000 8% preference share in issue. The nominal value is $1 and the current market price is $121.20. We have the question will be what is the cost of preference share? Very simple. Solution will be formula will be KP equal to D divided by PO. D will be 8, the constant dividend. P0 will be the current market price is $1.20. We converted into cents, so will we get 120. So 8 divided by 120 equal to 0.066, or we call this 0.7%. This topic is very easy. Just remember the formula D divided by P0. So let's move forward. The next topic we are going to cover today was estimating the cost of debt. What are the types of debt? There are two types of debt. First one which are traded in the market, and second one which are not traded in the market. So are traded in the market. First one was irredeemable debt, which means in irredeemable debt, in this the company will not repay the principal amount. The company will pay the interest forever. The company will pay forever. The company will pay the interest forever. And second one was which is traded is redeemable debt. In this, company will pay the interest until the redemption of the principal amount. This means that the company will pay you the interest until the redemption of the principal amount. And third type will be convertible debt. In this The investors may in future converted the debt into the fixed amount of equity shares. And the second type, which are not traded into market, we are there is the second type which are not traded into market is non-traded, and this is a bank loan. Now we are going to do each one of in details. Before we are going in each one of in detail, there's a one important topic before we are going into proceed. We do first that is the tax relief. Is very related to the that when we are estimating the cost of debt to the company, not the individual investors point of view. So let's begin. Let's first we understand the impact of the tax relief. Okay. Considering two companies identical apart from the choice of the finance, A is all equity finance and B has 10,000 at a $10,000 at 10% fixed rate debt. So we see that the profit before tax, interest and tax is 10,000 company A and company B also 10,000. Interest cost, A is all equity, so there is no interest cost. B is fully financed through debt, so 1,000 will be debt. 10,000, 10% is 1,000. Profit before tax will be 10,000 A and B is 9,000. Tax will be 3,000 and B will be 2,700. You see that the difference, that in company which are fully financed to equity, there will be no tax relief. In which, and you see that in company B, that the tax relief will be there of amount 300. B company has to pay $300 less tax because of tax deductibility of debt interest. So it is very important to understand that when the company is paying the interest, they also getting the tax relief. Okay, when you are calculating the cost of debt from the point of view of company, you considering the tax relief. When you are calculating the cost of debt of debt holders or individual investors, you will not considering the tax relief. So first one we are going to do is irredeemable debt. It means that the company does not intend to repay the principal, but they have to pay the interest forever. It means that the company does not intend to repay the principal, but to pay the interest forever. When we are calculating the cost of irredeemable debt, we have to assume two things. First one was the market value, that the future expected income stream from the debt should be discounted at the investor's required rate of return. It means that the future expected income stream from the debt, it should be discounted at the investor's required return. Now second point, we have to assume that the expected income stream will be the interest paid perpetuity. There will be no breakdown. There will be no breakdown of the paying the interest. The expected income should be paid till perpetuity. So the formula of calculating the irredeemable debt will be KD equal to I divided by MV, whereas I equal to annual interest in dollar starting in over 1 year time. The interest will be received in 1 year time. MV will be the market value of the loan notes, and KD will be the cost of debt. Okay, so in this you have to considering the tax relief which I told you earlier in this video, that the required return for the debt holder can be found through this formula is equal to KD equal I divided by MV. It means that for the individual debt holder, you should not considering the tax relief. For the point of your company, you have to consider the tax relief. The post-tax cost of debt to the company can be found through the formula by taking into consideration of the tax relief on interest will be KD bracket में 1 minus T bracket close equal to KD bracket 1 minus T bracket close equal to I bracket I minus T bracket close divided by market value. T will be denoted as the rate of the corporate tax expressed as a decimal. So we are going to do one question on this. So the question is on the inheritable debt is that the company has issued 10% inheritable debt quoted as $80. The corporate tax rate is $30. There is two requirements we have to do. First one was what is the return required by the debt provider. This means that we have to calculate first for the individual, for the debt holder, and second will be what is the post-tax cost of debt to the company. So let's begin. First we write what is a market value. Market value will be 80. Coupon rate means tax rate will be 30%. And the interest is 10%. One more thing, you always remember that whenever there is a question on debt, you always take the nominal value will be 100. Okay, the formula you all know, KD equal to I divided by market value. So I will be equal to 100 into 10% divided by 100 divided 10, and the market value you know is 80. We put into the formula equal to I divided by 10 divided by 30 divided to 0.125. We multiply by 100, you will get 12.5%. This will be the first one answer. In second one, the market, in second part, we have to calculating the post-tax cost of debt to the company. This will be from the point of view of company. So the market value of this will be 30. Corporate tax you know is 30%. 30%. Rate is 10%. So formula you know is KD bracket 1 minus T is equal to I bracket 1 minus T bracket close divided by market value. So we put it to the formula equal I is 10 is bracket I 1 minus the rate is 0.30 bracket close divided by market value is 80 is 0.875 equal into 100 we get 8.75%. So this is the question you will get on in this will be the question you will get on inheritable debt. It is very easy, just remember the formula. For the individual debt holder, KD equal to I divided by market value. When we are considering the tax relief to the company from the point of view company, the formula will be KD bracket 1 minus T equal to I bracket by 1 minus T divided by market value. It's very easy, just remember the formula. There will be another question for you all on inheritable debt. Please do it for yourself. This will be a practice for yourself. I read the question for you all. I am going to read this question for you all. This will be the homework. Please do it by yourself. This is very easy question. If you not able to do it, please comment down. I will help you all. The question was, a company has inheritable loan notes currently trading at $50. The coupon rate means that the interest you are receiving from the company, and the rate of the corporate tax is 30%. In this we have to calculate two things. First one, what is the return required by the debt providers. is been the pre-tax cost of debt. Second one, what is the post-tax cost of debt to the company? It is This is very similar to the above one. Now we are moving forward. The second topic we are going to cover is redevable debt. In this, the company will pay the interest for the number of years and then repay the principal amount. It means the company will pay you the interest and until the time period when they return in the principal amount. Okay, it's very simple, very simple. First, when we are going to do when we are going to do calculating the cost of debt of redevable debt, we assume two things. First one was the market value is very similar to the first one. When irredeemable debt, my future income streams from the loan notes would be discounted to the investor required rate of return. It means it would be discounted to bring back to the present value. That the future income streams should be calculated presented at present value when we are calculating the cost of debt. Second one, that the expected income stream will be interest we are receiving, and second one, the repayment of the principal amount. In the irredeemable debt, there will be no repayment of principal amount, but in redeemable debt, you are receiving the repayment of the principal amount. And third one, hence the market value of redeemable note is the sum of the present value of interest and the redemption payment. Please remember that. Hence the market value of redeemable notes is the sum of the present value of interest and the redemption of the payment. Okay, now we are moving forward for the formula. The formula very simple. The return and investors require can therefore be found by calculating the IRR. I assuming that you all know what is IRR and how we calculating the IRR. So the formula we are doing for this will be T0. T0 is when the market value is negative. When market value is always denoted as negative. Second, TI1 till the period of time you are receiving interest, and TN is the time when you are receiving your capital amount, when the company is paying back you the capital amount. Okay, now we are going to do one question on this. Question is that question is that a company has issue of 12% redeemable debt with 5 years to redemption. 5 years tentative period of 5 years when the company pay you full amount. Redemption will be at a nominal value. The current market value of debt is the $107. The corporate tax rate is 30%. What is the return required by the debt provider is being pre-tax. We are calculating the cost of debt of individual investors. Okay, let's begin. The nominal value, always remember the nominal value of loan note will be 100. Market value will be 107.159 and interest will be 100 multiplied by 12 divided by 100, 12%. Okay, let's begin. We have to calculate the year you are receiving. I assuming that you all know about what is IRR. When we are calculating the IRR, we are assuming two factors. One is small and one was large. In a small, we getting the positive NPV, and second, about the larger discount factor, we are receiving the negative NPV. So let's begin. For year 1, 0, year 0, 1, 2, 3, 4, and 5. Particular market amount will be the current market value. Market value will be negative. Always remember, market value will always be negative 107.59. Interest will be 12. Interest will be 12. Interest will be 12. Interest will be 12. In the last year, the company will pay you full amount. So 100 plus the interest amount will be 112. Okay. will be equal to 100 is for discount factor. Always remember this question formula: 1 divided by 1 point, what is a discount factor? Discount factor is 5%, so 0.05, then will be the bracket. Click on the year 0 to get yes, you will get 1. Now scroll down to till 5, you will get all the discount factors. Okay, here will be the present value. Very simple. This, click on this, multiply by 1, you will get all this. Just scroll down, will get all this. The NPV will be sum, bracket close, top to down, you will get 49.05. For the same we have to do for discount factor for the 15%. So 1 divided by 1.15 bracket 0 1. We just scroll down to till last. We are receiving 107 into 1. Just scroll down. This, you are getting the negative NPV in this way. Okay, minus 17. Okay. The formula for IRR will be L means N means the lower rate will be 5% plus bracket NPV at lower divided by NPV at lower minus NPV at higher into bracket open. H means higher NPV minus the higher rate discount factor minus the lower discount factor, bracket close. We do the same here. Open. Lower rate will be 5%, so 0.05 plus bracket open. NPV at lower. NPV at lower will be 49.05. We have to divide it, bracket open, and PV at lower will be PV at lower is 49. There will be a minus, and PV at higher is minus 17. There will be a sign minus, plus. We have to plus is minus 17, bracket close. We have to multiply, bracket open, and PV at higher will be NPV at what is higher rate is 15%, so 0.15 plus 0.05 bracket close. You will get 0.19. So answer will be 19.8%. It's very easy, very easy. I again explained you. For year 0, for calculating cost of debt when there is a redeemable debt, always remember, write down the years in this order: 0, 1, 2, 3, 4, 5. Write particulars, write MP, MV. In this we write interest. We are receiving, we receive. So we write down this, there, interest. We denoted as negative. So we put minus 107, interest we are receiving 100 into 12, this. Until last year, in the 5th year, we are receiving the interest plus the full repayment or the nominal value 100 we are receiving. 100 plus 12. And you all know in IRR we have to assume two NPVs, one was higher and second one was lower. In lower discount factor we receive the positive NPV, in higher than the lower NPV we are receiving the negative NPV. For discount factor, always remember this formula: 1 divided by 1 plus discount factor, bracket into 1. So we say 1 divided by 1.005 bracket into this. Then we scroll down all this, we receive this. We have to multiply from discount factor 1 into the market value. Then first year the interest into the discount factor. Second, always we do till the 5th year. We calculate all of this. We receive the NPV of 49.05. In second, same as we do for discount factor of 15%, same we have to as 5% we have to do. We are receiving the negative 17.64. Is we calculate the IRR by using the formula. L means the lower rate 0.05 plus bracket open 49.05 means the NPV at lower rate divided bracket open 49 means the lower NPV plus the higher NPV minus plus bracket close into bracket open higher discount factor 0.15 plus 0.05 bracket close bracket we get a 0.19 we converted in multiply by 100 we receive in 19.86. It's up to you what the discount factor you are taking. So discount factor 5% or 15% or is up. We see how we calculate a redeemable debt from the point of view of company. We can still use IRR, but we have to consider the interest relief on this. We can use this formula if it is post tax or cost of debt to the company that is required and IRR is still calculated but has the interest payment are tax deductible. The IRR calculation is based on the following cash flows. The formula we can use is T0 market value same as before, T1 minus but the T current year to till the period when the repayment is interest payment into minus 1 minus T. T will be tax rate means S, then the year which the redemption is going to be made, capital repayment it will. Now we are going to do a question on this. The question was a company has issued 12% redeemable debt with 5 years to redemption. The redemption is at nominal value. Nominal value will be 100. Always be remembered. The current market value of the debt will be 107.59 cents. The corporate tax will be 30%. Now, as earlier, we assumed that the discount factor will be 5% and the 15%. Same as we zero market value we can write here is minus 107.59. Interest in this we have to include the tax relief. The interest will be 12% is 200 and 12 by 100 it will be 12. So we can say that 12 into bracket 1 minus corporate tax is 0.30 divided by we get 8.4. In each year we get 8.4 as a interest 8.4 and in the last year 100 plus 8.4. Now for discount factor as usual 1 divided by 1 plus discount factor we can get to 1.05. Get it into 0 we get 1. We go but scroll down we get the discount factor for each year. The NPV will be equal to sum of this. Scroll down we get 7.133. From 15 factor from discount factor for 15 we do the same 1 divided by 1.15 bracket then we do 0 we get 1 point. We scroll down again we get the same value. How I getting like this multiply by this and the multiply we get this. So this multiply by this amount we get this amount. Just we scroll down this we are getting these also. For the NPV for 15% we have to scroll down like this minus 29. Now we use IRR formula. The IRR formula will be L lower rate plus NPV at lower divided by NPV at lower minus NPV at higher multiply bracket then we have higher rate minus lower rate bracket close. We can use same formula on this. equal to lower rate will be 0.05 plus bracket NPV at lower rate will be 7.13 divided by bracket NPV at lower will be 7.15. Minus minus will become plus 29.71 bracket close into bracket and PV at higher will be 0.15 minus 0.05 bracket close. We get 0.06. The answer will be into 100. We get 6.93%. Always remember, keep the answer up to 2 decimals. So answer will be 6.94%. 6.9%. So this is the redeemable debt. This is very easy. Just remember, to the cost of the company, we have to consider while we are calculating the cost of debt to the company, we have to consider the tax relief. For redeemable debt, we use IRR to calculate the cost of debt. IRR formula will be IRR equal to L means lower rate plus bracket NPV at lower divided by NPV at lower minus NPV at higher into bracket and higher rate minus the lower rate. You will get the cost of debt of redeemable debt. Now we are going to do third type, convertible debt. Convertible debt means that a form of loan notes that allow the investors to choose between taking the redemption proceed or converting the loan notes into preset number of shares. It means that the investors may convert their loan notes into the preset number of shares in the futures if they want. So while we calculating the convertible debt, we have to consider 3-4 things. First one, calculate the value of conversion option by using the available data. Second one, compare the conversion option with the cash option and assume that all the investors will choose the option which have higher value. And third one, calculate the IRR of the flow as a redeemable. We have to calculate the cost of debt as same as we are calculating for the redeemable debt. And the last one, there will be a no tax effect on this. So we have free from tax relief on this. So there will be no tax effect whichever option is chosen at the date of conversion. So let's see a question on this. Now we do a question on the convertible debt. So the question was, a company has issued a convertible loan notes that are due to be redeemed at 5% premium in 5 years time. The coupon rate is 8% and the current market value of loan notes is $85. Alternate, the investors can choose to convert each loan notes into 20 shares in 5 years times. The company will pay tax at 30% per annum. The company's shares are currently worth of $4. Their value are expected to grow at a rate of 7% per annum. In this case, we can ignore the tax rate. Okay, you remember in the slide we have to not to consider the tax rate on the convertible note. So while we doing the solution, we first compare the redemption value. First we get from the company is a cash redemption. Cash redemption means that the loan notes will be redeemed at 5% premium. So 100 into 1.05. How I get 1.05 is 1 plus 0.05. So I getting 1.05. We calculate, we get 105. And then you are clear about how we get cash redemption value 100 into 1.05. Now if the investors converted their convertible loan notes into the shares. So how much value he will getting? So the current share price of the companies was $4. How many shares he will be getting is 20 shares, and there was a growth in the shares is 7% over the period of 5 years. So 1.07, then the bracket and 5, we are getting 112. We have to assume that the investor will choose a higher value, so he will go for the conversion value option. He will get shares instead of cash reduction of 105. So we have to calculate the cost of debt using the same formula by year, particular amount, discount factor. In this we are also assuming that the discount factor will be 5% present value, and the discount factor is 15%. Year 0, the market value is 85. 85. Year 1, year 1, year 2, year 3, year 4, and year 5. I think year 5 till 5 years, okay. So year 1, year 2, and year 1 will be the interest. How much interest we are getting is 8%. So we are getting around 100 into 8 divided by 100, we are getting 100 divided by 100 into 8 divided by 100, we are getting 8. In all years we are getting 8 amount. In the last year we are getting 112 this amount, 112 this amount, plus the interest 8, okay, 120 we are getting. Discount factor as usual we have to do 1 divided by 1.05 like this, and we get 1. We scroll down, we have to calculate a present value, then we have to do this 85 multiply, we getting this amount, sum, we getting the NPV by calculating sum, and this we get it 202. There was a problem, I not put the minus sign here, so we are getting 32 for discount factor. 51 divided by 1.15 bracket like this, 0, we are getting 1. This scroll down, present value equal to this 1, so sorry, amount this into 1, we are getting minus 85. We scroll down, we are getting this value down, and PV we are getting minus 7. Now we have to calculate the NPV. The formula for IRR equal to lower rate plus bracket NPV at lower divided by NPV at lower minus NPV at higher into bracket higher rate minus the lower rate bracket close. So we do the same here. Lower rate 0.05 plus bracket NPV at lower will be 32 divided by low NPV at lower will be 32 minus plus 7, then we have to into, then bracket NPV, the rate will be higher rate will be 0.15 minus 0.05 bracket close, we are getting, wait a minute, something is there wrong. So we are getting 13 points, so you have to do 0.13 0.05 plus bracket 32 is the NP weight lower divided by bracket 32 NP weight lower plus the higher MPV minus then plus bracket then bracket into bracket in 0.15 means the higher rate plus minus the 0. Lower rate. You are getting 13.2%. This is the convertible that question. You all are clear. If not clear, please go back to the video, understand each one of each step very carefully. It's a very easy topic in the FM level. In FM level, this level is the highest level they will ask the questions like this. So we do the last type of debt is a traded debt. Traded debt is the non-tradable debt. Bank loans, other non-tradable fixed interest loans simply need to be adjusted for the tax relief. It's not too much. It's very easy, very easy. There is nothing in this we have to do. Is equal to cost to company means what the cost to the company. The formula will be cost is equal interest rate. What is a coupon rate into 1 minus t. 1 minus t will be the tax rate you are going to do. The company is paying. It's very easy. It's nothing. I show you one example question on this. The question on the non-tradable debt will be a firm has a fixed rate or rate bank loan of $1 million. It is charged 11% per annum. The corporate tax is 30%. What is the post-tax cost of loan will be? So we see a solution. The solution will be the formula of the non-tradable debt will be interest rate into 1 minus t. So 11% into interest rate into 1 minus the tax rate is 0.3. You will be getting 7.7%. So are you clear on the non-tradable debts? Are you guys clear on this topic? Non-tradable debt. The formula is very simple. Interest rate into 1 minus t. So remember this formula. From my experience, this question is never be asked in the question in the exam. So please focus on two topics, mostly on the cost of equity, and in the debt you have to focus on the redeemable debt and the convertible debt. These three topics are most important. So that's all from this topic, from this point of view. Thank you for all for seeing my video and listening. Please provide me the thank you for watching my videos. This is that's all. The third part will be focusing on how we calculate by calculating the cost of capital by taking the cost of equity and cost of debt together. So in this video we are going to do that. So first, if you please understand each one of topic clearly, then and only you understand the third how we are calculating the cost of capital by using the cost of equity, cost of preference shares, cost of debts. Okay, for students who not watch the video on cost of equity, please go and watch the cost of equity, clear them. And for cost of debt, thank you very much for watching my video.